Hello and welcome to the first video in this chapter where we will learn about concepts such as consumer and producer surplus and deficit to help analyze the efficiency of a market. In this video I will explain and illustrate the concept of consumer surplus. But before we begin, please note that in order to understand the topics and calculations within this video, it is important that you understand the concepts of supply and demand, and have some mathematical ability in calculating the area of a triangle. Before we start, we first need to make sure we understand the connection between consumer demand and marginal benefit. The reason why we need to make this link is because the demand curve is essentially a curve which illustrates marginal benefit. Let's take a closer look to understand why. Firstly, when we are willing to pay a certain price for a good or service, we are expressing the value which we personally attach to that good. We normally consider ourselves as rational humans, so in economics we assume consumers won't pay for goods or services which they do not feel is worth the price. When we purchase and consume a good, we receive a sort of benefit from doing so. It's not easy to quantify this benefit because there is no standard measure of satisfaction or happiness. What we do know is that we derive a benefit from all goods and services we consume, and that benefit falls the more of the same good we consume. For example, the first biscuit I eat with my tea is more satisfying than the second biscuit, and the second biscuit I eat with my tea is more satisfying than the third biscuit, and so on. This is known as the law of decreasing marginal benefit. So as we consume more of the same good, our satisfaction or our benefit decreases for every additional good we consume. The marginal benefit then is the benefit we receive from consuming the last good or service. In our example, marginal benefit is the benefit or satisfaction I received from consuming the last biscuit I ate, up until the fourth biscuit. But why is marginal benefit so important, and how does this all tie back to demand? A good question to ask to help illustrate why marginal benefit is so important is, why didn't I eat a fifth biscuit in my example? I didn't eat a fifth biscuit because I felt that the cost of an additional biscuit was not worth the benefit I would receive from consuming it. So marginal benefit tells us that the benefit received from consuming the last good or service is equal to the maximum price we are willing to pay for that good or service. If this wasn't true, and the benefit was greater than the cost, then we would buy additional units of that good. So I will continue to purchase more biscuits so long as I feel that the benefit I receive from consuming additional biscuits is greater than the price it costs to purchase them. I will stop purchasing additional biscuits once I feel that the price is no longer worth it. What we have just described is actually a demand curve, which illustrates how much a person is willing to pay for different quantities of a particular good. So the market marginal benefit curve is actually the same as the market demand curve. So by understanding the link or connection between a consumer's benefit and the price they are willing to pay for different quantities of goods, we can investigate how their overall benefit changes when market conditions such as price change. Figure A illustrates the market demand curve for beer. As we have just discussed, the demand curve is actually the same as the marginal benefit curve, because the demand curve illustrates the amount in financial terms that the market is willing to pay for the last liter of beer consumed at all the different quantity combinations of beer. It's almost as if you're thinking of the demand curve in the reverse. Instead of thinking how much people are willing to buy at different price levels, ask yourself, how much are people willing to pay for different quantities? For instance, at point D on our demand curve, we can see that the market is willing to buy 200 liters of beer if the market price is $10 per liter. Or we could say that if the market was given 200 liters of beer, then given the benefit the market receives from this beer, it would only be willing to pay $10 per liter for that beer. Let's use an example to illustrate how we can use the demand curve to analyze consumer benefit. Let's assume the current market price is $10 per liter. The demand curve shows us that the demand for beer will be 200 liters. But what about the consumers that were willing to buy beer at a higher market price? The demand curve also tells us that if the market price was higher than $10 per liter, let's say $20 per liter, then according to point B, 100 liters of beer would still be purchased, even though the price is higher than the $10. This tells us that at a market price of $10 per liter, there are consumers who are paying $10 per liter for beer, even though they would have paid $20. These consumers are therefore benefiting from the $10 price level because they are willing to pay a higher price. We can say the same thing for every price level above the current market price level, and we call this benefit consumer surplus, and it is defined as the difference between the highest price consumers were willing to pay for a good or service and the current market price. Or another way of defining this benefit is that consumer surplus is the difference between the lower price that you are paying and the higher price that you were willing to pay. The consumer surplus between the $10 price level and the $20 price level can be seen by the black line between the price level and point B. The line represents the consumer surplus for those consumers that would have paid $20 per liter but are actually only paying the current market price of $10 per liter. But what about all the other consumers? For example, what about those that were willing to pay $25 or $30 or $16 per liter? If we want to know the total market consumer surplus, we need to add up all the black arrows, which is impossible to do one arrow at a time, as there are an infinite amount of arrows between 0 and 200 liters. What we can do, which is the same as adding up all the arrows, is calculate the area above the current market price and below the demand curve. This area is illustrated by the light green triangle. To calculate the area, we simply take the base, which is equal to 200 liters, and multiply this by half the height of the triangle. The height of the triangle is equal to $20. We can see this by taking the $30 and subtracting the bottom $10. And so half of $20 is $10, which is half the height of the triangle. The area of the triangle is therefore equal to 200 liters multiplied by $10 per liter, which is $2,000. This $2,000 then represents the market consumer surplus, because there were so many consumers that were willing to pay a higher price than what they currently are paying. But what happens if the market price increases? If the price increases, we know, according to the law of demand, and by looking at the demand curve, that the demand for beer will fall. Let's assume that the price level increases to $15 per liter because there was a poor barley harvest which has made one of the ingredients in beer more expensive. At $15 per liter, the demand curve tells us that only 150 liters will now be purchased. So if the price increases to $15 per liter, then all those consumers who were previously experiencing a consumer surplus, because they were willing to pay more than $10 per liter but less than $15 per liter, are no longer benefiting from the old $10 price level. But all consumers who are still paying or who are still willing to pay more than $15 per litre for beer are still benefiting from a lower price and therefore are still experiencing a consumer surplus. So again, all we need to do is calculate the new consumer surplus by calculating the area under the demand curve and above the market price level. This new market consumer surplus is represented by the green triangle. For the new higher price level of $15 per litre, the height of the triangle is $30 minus $15, which is $15. The base is now 150 litres. So half the height, which is $7.50 per litre, multiplied by 150 litres, gives us a new market consumer surplus of $1,125. So you should notice that this is lower than the previous market surplus, which was $2,000, which is expected, because the market price level went up. So naturally consumers lose out because they now have to pay more. So what we have just done is used a purely simple demand curve and the current market price level to show how we calculate, or how we can calculate, consumer surplus or a sort of consumer benefit. Remember, the demand curve, although it's telling us price levels and quantities demanded, it also represents benefit, and thus the area below the demand curve but above the price level can be considered a sort of benefit, which we are calling consumer surplus. And the higher the price level, obviously the lower the consumer surplus, and the lower the price level, the more consumers benefit from a lower price, the higher the consumer surplus. In later chapters, we will look at producer surplus, and we will use the two concepts together to look at market efficiencies. But that we will cover in a later chapter.